You know, the topic, hot topics, I really don't feel like a hot topic. But when you're playing the back nine, you'll take it if they'll give it to you. So I'll be a hot topic today. My career has been mainly in the public market. 90% of it has been a public company. I went to work for Southland Royalty Company. And I had a buddy that was a fraternity brother whose father was chairman. And so he mentioned to me that I might be able to get a job with her. I was working to be an actuary in Philadelphia, and that was giving me a headache. I knew that I really didn't want to be an actuary. So I looked at this company, Southland Royalty Company, and it had a $100 million market cap. It's a public company in the American Stock Exchange, had no debt, 60% gross profit, and a horrible business plan. I mean, they pissed off their entire cash flow every year and didn't add any value with it at all. They drilled wildcat wells, dry holes after dry hole. And so my buddy and I, we were analyzing this in Philadelphia. He said, you know, if you can't make that baby sing, if you can get in a position of responsibility, you ought to really be ashamed of yourself. And so I decided I would go give this a try, our interview with Mr. Weaver. And I went down and talked to him, and this was over several months. And he finally said, well, do you want this job? And I said, well, yes, sir, I do. He said, well, how much money do you make now? I said, well, I make $15,000 a year. He said, okay, I'll give you 13. And my brain was going, and I said, well, Mr. Weaver, will you pay my way to move to Fort Worth from Philadelphia, and I had a family, and you'd saved as much as you could, and I'd borrowed money to go to school. He said, nope, you have to get yourself down here. So I took that job, paid my way down there, and for his benefit, I guess about 6 months later, he raised me $2,000 to the $15,000 that I had given up. But if you look back at the times, and some of you are in the oil business and in the crowd here, but back then, oil was $3 a barrel, and it had been $3 a barrel for 20 years. I mean, it was just flat. And every year, Exxon and Shell would get together with the Saudis, and the Saudis would always want a little bit more, and they wouldn't give it to them. They just said, nope, $3. And in about 1971, the United States oil production peaked. And we didn't talk much about it, but the Saudis noticed it. And so in '73, the Saudis said, we think we want $5 a barrel. And Exxon and Shell said, no, but we'll give you $3.70. And so what happened then is everybody went home to their governments to discuss whether or not they were going to give $5 or take the $3.70 or whatever. And the same year, Egypt decided it wanted its territories back that Israel had taken in the Six-Day War. And so, whose side are you going to be on now? Because obviously the Arabs had all the energy. Russia had decided to back Egypt, and we couldn't let them get a real foothold in the Middle East. And so we backed Israel. And the Saudis had told us something bad would happen if you did. And we won the war. I mean, we backed Israel, and that's why they won the war, really. But the Saudis said, you're going to read about what's going to happen to you in the newspaper. And sure enough, the embargo happened. They cut off the oil supplies for everybody that had backed Israel. OPEC really got strong. And from that time on, oil was never $3 a barrel again. I mean, oil has gone up and down, and it's been in short supply. Or it's been, so for some short periods of time, it'll be in oversupply. But it's trended up. And so at Southland, we said, look, by the way, the job that I took was administrative assistant. And I was administrative assistant to no one. I wasn't in administration, and I wasn't an assistant to anybody. There's some people here that worked with me back then, and so they're nodding yes. I mean, it was a really interesting company to go to work for. But we decided that we were going to look at acquisitions and instead of be a wildcat company. And it just fit the fact that oil, or our belief that oil and gas were going to trend upward. And so I can remember the first acquisition that we worked on was one that in West Texas, and this was pre-computer. And so our computers had just come into existence, and we bought a national cash register computer. And that computer was all these cards. And you didn't have programs like you have now. I mean, it was all machine language, and you had to learn how to program that thing from basic language. So I learned how to do that. And we were working on this acquisition. It was a $6 million acquisition. And I guess I didn't trust the computer. I didn't trust the answer. Stayed up all night long, manually doing that acquisition to check to see if the computer was right. Now, you would think about doing that, you had more confidence in yourself than you did in the computer, but sure enough, it happened to come out with the same answer. We paid $6 million for that deal. And we started making larger and larger acquisitions, but still, we hadn't gotten to the point where we really had it going. And Boone Pickens noticed this, and so he decided to tender for Southland. Now, I was still an administrative assistant when he tendered. And I wasn't going to tell this part of the story, but 2 days ago in the Wall Street Journal, a guy named Joe Flom died, and they had a big obituary and had his picture on I think it's the C section of the Wall Street Journal. Well, Mr. Weaver came in and said, yeah, you're the only, we didn't have a CFO. He said, you're the only one that looks like a CFO here. Go to New York and get a team together. And so I went to New York and hired Bob Rubin at Goldman, who was my age then, and we were really young, and Joe Flom. And so Pickens didn't know that I existed. He didn't know we had hired a team. Like Joe Flom was just 45 then. He was the greatest M&A guy, and he made Skadden Arps. And so put together this team that was really formidable team, and we kicked his butt. I mean to tell you, it was absolutely wonderful. Then he did a tender offer for us, and we kicked his butt again. I mean, it was the most thrilling thing for a guy like 31, 32 years old. And so then I was made executive vice president, and Pickens offered me a job. And so I went to Mr. Weaver and said, you know, hey, this is really a good job. I'm going to be executive vice president of Mesa, and I'm going to get stock options, and he's going to really, it was really, I wasn't making a whole lot more than $15,000 a year, but. So Mr. Weaver said, oh, no, you can't do that. So he did a little better than match Pickens' offer. So I said, Boone made me, you know, he made my career. But then shortly thereafter, I was made president of Southland. And it's at that time we came up with our first business plan, and this is really what I want to talk to you today, is really about business plans. And it's fun to talk to somebody about business plans, especially when you're looking backwards, you know, because they get a whole lot better when you're looking backwards than when you're going through it at the time. But our business plan was to acquire oil and gas reserves that had really quality reserves, long life quality reserves. We were going to use bank debt. We'd acquire each property, we'd use 50% bank debt, and we were going to create wealth for the investors. Now was pretty easy to do when your chairman has his family had 30% of the value of this company. They had 30% of the stock, and they hadn't done well. And so, you know, Mr. Weaver was really eager for his family to make some money out of this thing. The company had been founded in 1925. So, you know, that's how we started thinking about royalty trusts. And when Jim talked about having public companies in the New York Stock Exchange, we took Southland from the American to the New York Stock Exchange, and then we decided we would create two royalty trusts, and we created the Permian Basin Royalty Trust and the San Juan Basin Royalty Trust. And a royalty trust is a grantor trust, and it can't make business decisions. It can't hedge, it can't drill wells, it can't borrow money. The only purpose of it is to distribute revenue. And so we created the Permian Basin out of old Southland minerals, which are great properties. And then we created the San Juan Basin Royalty Trust out of properties that we acquired in a tender for Aztec Oil and Gas Company. Now, Boone started the tender. He did the hostile. We couldn't do a hostile with our board, but he started that, and he did the hostile tender. But we had already studied it, and this time Joe Flom was on his side. But we came in and beat him in that tender offer. There were several companies that had tendered. But it was a fabulous acquisition in the San Juan Basin. And it was $167 million and a trillion cubic feet of natural gas. So it was proved developed reserves were 16 cents an MCF, which is just absolutely unbelievable because it had so much infill drilling to do. And I know some of you are not in the oil, or most of you are not in the oil and gas business, but these were lenticular sands and submerged sands. And they were lenticular like lens pods, or you can look at it kind of like a pancake. And if you could imagine a big wash tub full of pancakes, well, when you drill a new well, you hit some pancakes that have not been hit before. And every time you did that, you got virgin pressure, and you're almost into a new reservoir. So we were getting tremendous wells as we downspace that. And we created immense wealth with this infill program. And so as we had developed that, then we decided that we would give those two trusts to the investors as opposed to sell them to the public. Southland never went to the public market at all. The only thing even close to doing that we did was we went to the bond market a couple of times. But we never sold any equity. And so we gave these to the investor. It caused them a tax problem because we didn't give them any cash to pay their taxes. So they had to sell some of the units, and some of them were quite angry. But they shouldn't have been, because if you look, if you reinvest those dividends back into, or the unit revenue back into the trust itself, I've always done that. As we've issued these things, I've always kept mine and reinvested it. And now, even though it's, you built the cost up over time because you're reinvesting it, but that pays me 16% a year now. And it's 6% a year if you were to buy it brand new. It's paid out 20 times, and it pays out every other year on the original investment that we paid for it. So it's just been a fabulous wealth creator. And if you ever look at these things together and combine, the three that we did, and we've outperformed Exxon, just about everybody. I mean, those royalty trusts are really neat. I don't know why more people haven't done them, but it was a great part of our business plan to build wealth. The one problem with it is that once we issued all that value, we maintained the debt at Southland. And the only way in a public company to pay down debt, especially if you've got too much, is you either sell equity, which we didn't want to do, or you pay down debt with cash flow. And once you start paying down debt with cash flow, your growth pretty much stops for that period of time, and your stock drops. And back in these days, in the 80s, when your stock dropped, somebody came in and tendered for you. I mean, that's the way things worked back then. And so I was hoping that we could escape being tendered for and get through this program by paying down debt with cash flow. We didn't make it. In 1985, Burlington Northern tendered for us, and this is the railroad, and they got in their tender about 45% of the stock. So we actually beat them, but we were smart enough to know that you're not going to fight a railroad over 5%. If they wanted that 5%, they were going to get it, and so we capitulated. We talked to 64 other companies. We put ourselves up for sale. That was the highest offer we got. And an interesting thing about that, when they tendered in October, oil was $27 a barrel. We capitulated, gave in to them. When it closed in December, oil was $10 a barrel. And so you talk about lucky. I mean, we would have been stuck with all that debt trying to pay that back. Our cash flow would have gone down by at least a half. I mean, as Bob Simpson always said, God was sitting on our shoulder that quarter. But that's what happened. And then Bob Simpson, who was our CFO, and Steve Palco and I was in charge of acquisitions, just started Cross Timbers Oil and Gas Company. And the symbol for Cross Timbers was XTO. And so the name was later, nobody understood what Cross Timbers meant. It's a region in our area, and we thought it was pretty cool, but nobody in New York understood that. And so they changed the name to XTO. I was at XTO for 10 years. We changed the business plan a little bit at XTO, and but what we did was we said, okay, instead of buying just long life production, we would qualify that a little bit, that the long life production that we bought, you had to be able to replace the production decline with half a cash flow. And so if it declined 5%, you had to be able to invest that money back into those properties where they would be flat again. And then you could use the other half of cash flow to pay down debt or to grow the company. And so that became, you know, something that we created through models, and it's worked. And Bob Simpson and I to this day believe that's really one of the key reasons for the success of our career. But we also were trying to build wealth there, obviously we were, and we created yet another royalty trust, the Cross Timbers Royalty Trust. And so we sold half and kept half in the company. We got a little smarter than we were at Southland. But the business plan has been enormously successful. And, you know, I've been out of XTO for 16 years, and so I really can't take any credit for it. But you know, they sold that company, you know, this past year for about what Exxon paid for Mobil. And you just think of that as really been one of the great stories in American capitalism. The same guys were there. You know, after I had been there about 10 years, I was, I guess, bored would be the best way to say it. Everything was going so smooth, and the business plan was working, and everybody had these, you know, great jobs, and I just wasn't. You know, I don't know. I felt kind of funny about it. So Becky and I were talking about it one night, and she said, "Well, you know, when have you really been happy?" And I said, "Well, I really was happiest when I was trying to turn Southland around and work on a business plan and get something going, or when we started XTO. I mean, that's when the real struggle happens, and that's when it's really difficult." And she said, "Well, do it again." So I decided, well, heck, I'll do it again. So I phoned my son, Johnny. He was working in Houston, and I thought, boy, he'd just jump all over this. I said, "Johnny, let's start a company." "Yeah, I don't know, Dad. I'm doing pretty good down here in Houston. I got a good job, and I don't know if I want to do that." And so I just thought, wow, that's crazy, you know. So it took me about a week to talk him into it. Finally talked him into it, and so then I had to go tell Bob and Steve. So I went one morning, three of us sat down, and they were really shocked and upset, and it didn't go well. And I said, "Well, I just feel like I need to do this." And so I didn't want to leave it like, well, we'll think about it overnight, because I'd made up my mind. So we came back the next morning, and they had gotten over whatever was bothering them, and they were ready to help me pack my boxes the next day. I mean, they were. I think they had gotten so excited overnight and talked all night long about what they would do, and so it absolutely worked out best for both of us. We put out an announcement that I was leaving. I was chairman of the board and had half of the general partnership that we'd started this thing with, and so, you know, we had some damage control to do and all that, but that all went really well. And once the announcement came out, Richard Rainwater phoned and said, "Look, I've put all this money into Mesa, and you're not doing anything. You know, why don't you come help me with my problems?" And I said, "No way, man. You have got a problem, and I'm not coming over there." Mesa in spite of him putting all that money in, it still had a negative value. And I did not want to do that. I must have turned him down 4 or 5 times. I said, "You know, Johnny and I are going to go together." He said, "Well, Johnny can go to work for me, you know, while you're doing this." I said, "No way, I don't want Johnny to work for you. I mean, we've got a plan." And Boone phoned and wanted to come see me, and he came over. And he said, John, you got to do this. He said, yeah, Richard and I don't like each other. I don't like anybody Richard likes. Richard doesn't like anybody I like, and you're the only guy I know of that we both like. And said, just hit Richard between the eyes with really a big, hard offer. So I thought, well, that's probably right. Negotiating with Richard when he really wants something is kind of like negotiating with Jerry Jones if you're really fast. So I negotiated a deal for Johnny and me. Johnny got 20% of the deal. I was chairman and CEO. Johnny was on the executive committee. Johnny was really young. And we went into Mesa. We had to perform a merger within 1 year to get our, all the bonuses and all that stuff we were going to get. And 1 year is really short when you're taking over a company with a negative value. And so I probably wouldn't do that again, because that was stressful and it was extremely hard. But we tweaked the business plan as soon as we got in. Mesa had had Hugoton reserves, which are long life, great properties, but they were declining, and it wasn't much you could do to turn that decline around. They had some offshore properties that were pretty good, and they had absolutely wonderful people. They had a wonderful staff. And so I went to the chief operating officer and told him, I said, you've got to flatten Hugoton for me some way. You got to figure out how you can do that. And he said, well, it's be expensive, but I can add compression and I can get that done. And I said, well, let's do that. So we kind of had that handled, but how do you do the rest of it? And I'd always developed good banking relationships because I'd used the banks. And so I went to Chase and I said, you've got to loan us the money for an acquisition. And they did. They had done some bonds for Mesa. And we bought a company with a real high cash flow. And so what the new twist in the business plan was, instead of each property having to replace production with half a cash flow, we used all the model, all the properties. And so what we wanted to do was make our whole profile where we could replace production with half cash flow. So we went out and bought this large, short life, flush property that we could stick on top of the rest of this company. And it was a shallow water offshore property. And then Johnny came up with the idea, because now oil was kind of in vogue. And so he said, Dad, I think we can, through derivatives, switch this gas to oil that we were buying. And we did that, and the street loved it. I mean, we could talk about being able to replace production with half a cash flow. We'd added oil when it was really gas. Our stock went up, and we managed to do a merger with Parker & Parsley, a company without much debt, and an oil company, primarily Sprayberry Properties, in West Texas. And we got our merger done with 3 days to spare. And so that was really something, though. But we formed Pioneer. Pioneer's been a great company. They have a different business plan. They're primarily a drilling company that buy leases and drill, but they've done great. But they've also created a royalty trust, and so that was pretty cool to see them do that. And then finally, Johnny and I started Encore Acquisition Company. One thing I left out, but when we started Cross Timbers, it was private equity through Goldman, and we raised $16 million. And Goldman, the fellow that raised the money was Bob Rubin again. And he raised it all in one afternoon. And $16 million doesn't sound like a lot of money, and it wasn't a lot of money then. But the important part of it is that even without a lot of money, the important thing is you've got to make money with that money. And if you can take $16 million and make money with that money, then 6 months later or a year later, you can raise $50 million. And you can raise that money, you can do $100 million and go to $300 million. But you always have to make money. And that's what I try to talk to these young people about that want to go into these types of businesses. It doesn't matter how small you start. The important thing is you have a business plan that's successful. And when we raised that money, Bob and Steve and I put up 2%, and we got 12% of every property that we acquired, and that was just assigned to us. And there was no hurdle rate. We were all on the same basis, and so we made that work for a couple of times. And then Reuben came back and said, we think now that 12% is too much. And so I said, really, what were y'all thinking? And he said, well, we think you shouldn't have more than 8%. I said, well, okay. Then we shouldn't have to put up 2. And he said, well, that's probably right. I said, well, what if we just put up 1? He said, that'd be okay. I said, boy, I'll do that deal all night long. I get 1 for 8 or 2 for 12. I said, let's do some more business. That sounds like a great no hurdle rate. And so that's how Cross Timbers was created. Well, now when Johnny and I go to start this Encore, the private equity guys are not so simple. It's not so easy anymore. And we put up 3%. We had 3 other partners. We put up 3% for 23% of the upside or the profit, but we had a 6% hurdle rate. But this time, the private equity people wanted us, and we did, say if we didn't make the 6% hurdle, we lost our 3%. And so, for me, it wasn't so hard because I had created wealth. But for some of these young guys, that was really difficult, and it really stressed them out. And the 6% hurdle is really what and so some of them had to cut back. And I've always wanted to hire a lot younger guys than I do. I mean, the secret to my success is hiring good partners. I mean, I've really done a good job at that. And I like young guys. But we did put them under a lot of stress. Our business plan will give you a 15% rate of return. I mean, I really believe that that's true, and that's a big rate of return. But we've always managed to do that. In any event, we did it, and we looked at our business plan. We just didn't change it much. Johnny came up with a new hedge idea for hedging, and he had learned a lot working with the Mesa guys because they were really good at commodities and hedging. And what we did was we said, okay, we'll take a third of the production and we'll buy puts or floors. And that's a very expensive way to go. But 2 or 3 years out, you pay a lot of money for that. We'll take a third of the production and do swaps, which don't cost you anything. And then we'll take a third of the production and leave it open. We won't hedge it. Now, what that lets us do is we're always 2/3 protected to the downside. If oil and gas prices go down, we're 2/3 protected. Well, if you're like I am, if you're bullish on oil and gas prices going up, then that's not so hard. And then you're 2/3 open to the upside. And so 2/3, if the oil goes to up $10 a barrel, you get 2/3 of that. If it goes down to $10 a barrel, you're protected on 2/3 of that. So other than being expensive, and it is expensive, it was a good plan, and we followed it. We raised $300 million. It took over a year, about a year and a half, to make our first acquisition. And if you're trying to buy quality, you don't want to just get started. And for much of that year, that overhead was coming out of my pocket. Or mine and Becky's pocket. Becky. But be careful what I say. But finally we got that taken care of with our backers. But they were getting a little nervous because they had put up $300 million. This was about 1998. And none of it was being used. And then we found that Shell might sell the Cedar Creek Anticline. The Cedar Creek Anticline is a great legacy property of Shell's. It's in Montana, in eastern Montana. It's an anticline, 60 miles long, 4 miles wide, hundreds of wells. If you can picture that Williston Basin, you're coming up out of the side of the Williston Basin, you have an anticline and you have this big fault that runs 60 miles, and this oil is trapped against that fault. Its field had been so good that when Shell wanted to do a water flood and drill water injection wells, every time they drilled an injection well, it would produce 1,000 to 2,000 barrels a day. Well, so they couldn't make themselves convert. I mean, they would not convert that into an injection well. They just kept producing it. Well, by the time we come along about, 50 years later, those wells are down to 50 barrels a day, which is still, a lot on the average. And, but they've got no patterns. Like anything else in seems like that works engineering-wise. You just have to have patterns. And so, you have to re-engineer those fields. And it costs a lot of money. We re-engineered the field. We did our pattern by what you call line drive, and we drilled a series of horizontal wells that we injected water into, and that water then pushed the oil to the next, you drill these 2 line drives, and these are producing wells in between. And you do this all up and down, and so as the water pushes it into the middle, and so we produce the oil out of that. And that carried us at least 5 years where we could replace production with half a cash flow. It was a tremendous field, still a tremendous field. It'll be a great CO2 field. When we bought it, it's an all-new board. I never worked with this board, a private equity board. And I told them, I said, look, these legacy fields just don't come along but 4 or 5 times in your 40-year career. And you have to buy this. And oil prices were $12 a barrel. And I said, in order to make sure you buy it, nobody's going to out-engineer us. We had covered that base. But I said, if somebody has a higher price deck, they'll buy it. And you have to believe that oil's going to go up. $12 a barrel is too low. So I convinced them that within 3 years, oil would be $20 a barrel. Well, that's a 20% compound increase a year. And these New York guys looked at me like I had to be crazy. And I said, well, it may not be there. I don't know that it's going to be there. But if you're going to make sure you buy this and have this kind of opportunity, this is what you have to do. Well, they finally went along, and oil was $20 a barrel when we closed. From the time we did the purchase and sale agreement, it was $12 to the time the deal closed, oil was $20 a barrel. It really looked smart. I think, when we made our bid and made our offer, the whole industry thought we were crazy. We didn't look more smart until it closed. Certainly we weren't that smart. We were just lucky on that deal going that way as we were on the Burlington deal going the other way. But you got to be lucky in this business. In most businesses, you got to have a lot of good partners and a lot of luck really help you. When we sold Encore last March, the private equity investors got 20 times on their money. We had been public for 8 years, and the IPO investors got 6 times on their money. And so it was really a great investment, equal to those investments at Southland and XTO, not as well known, but certainly created a lot of wealth for a lot of people. And I really credit the business plan, with my career. And I love business plans, and I love to help people work on business plans, and no matter what business they're in, I do this a lot, and I enjoy doing it. And I was fishing with a guy named George Pasala, who had been on our board, and he works for a company called Momentum. And we were talking about their business plan, and I said, George, I just got to meet your chairman. And his name's Bill Pritchard, and he lives in Houston. And I kind of really wanted to invest in, with Pritchard. And so we go down, it's a private company, and George introduces me, and we're talking about the business plan, and I'm about to bring up that I want to invest. And he looks at me and he said, do you remember a speech you gave to the IPA about 10 years ago? It was 12 years ago. And I said, well, I kind of remember it. And he said, well, you were talking about how to start, it's okay to start small. You're talking about business plans. He said, I was sitting in the audience, and I worked for GE Capital. And I said to myself, I can do that. And I get emotional, I know. And he said, I can do that. And I was just floored. I thought, wow, you really kind of helped somebody. And he forms Momentum, does a young guy, and makes all this money, or creates all this wealth for all these people. And so, it's really made me feel good about doing talks like this because, you never know that somebody's going to be out there, whether it's a Bill Pritchard or Jonny Brumley or Bob Simpson or Steve Palco. It's fun for me to do, and it's fun for me to talk to people about business plans and to encourage them, to go and be an entrepreneur because it's fun, and I've certainly enjoyed it. So thank you. I appreciate it.